Recipes for technical trading success in Cook's Kitchen.
Welcome to the bear hunt relief rally gone FOMO. FOMO, of course, stands for fear of missing out. Let's look at the details. Here's the chart I've been showing since February 15th. It's a weekly chart of the S&P with three probable scenarios after that bottom we made February 11th and 12th. And my base case scenario was the black path going up into the 1950, 1970 zone as a high probability target, fulfilling lots of objectives for the bear hunt. The green zone, the green path, is obviously my upside scenario. Where does that go? 2040 for the gap fill. The first day of trading in the new year, we come in, S&P closed at 2043 on New Year's Eve, and we gap right through 2040. So I've been showing that chart since February 15th. Here's the chart I've been showing since February 22nd of all the targets for the bear hunt relief rally. And a lot of fibs in here, moving averages to touch, gaps to be filled. Well, we are cruising through all of them, and all that's left is the big gap up at S&P 2040. And right now that's going on. This is Friday before lunch here. The melt up is on. We are through S&P 202 on the spiders. 202 is about the January 5th high. Through there, we're going to go all the way up now to 204 and fill that gap. Probably not today, since we already have a good rally on, but into next week, possibly even before the Fed tells us they're not going to hike rates, and maybe only twice more this year. All right, so here's a look at the action today. You can see the green ellipse up here. This is a weekly chart again. This pretty much marks the gap we need to fill up to 204 on the spiders, trading above 202. I've got 20, 40, and 80-week moving averages on here again to show trend. And what's significant, obviously, 20 and 40 have crossed bearish. Those are good trend markers for a big change in trend, typical of what leads into a bear market. And they are below the 80-week moving average, the green line, which has gone flat. So you've got a long-term trend line, that's rolling over. Now, is it going to roll over? We don't know for sure. That's the way things are looking. It makes the bears, whet their appetite, and everybody's looking at all the reasons to be bearish. Mine is still the earnings recession. We'll come back to that update in a second. I want to point out the MACD on the bottom. MACD is just, it's telling you what's happening. So the same thing you're seeing with long-term moving averages rolling over. Well, what happened during the bull market? The MACD was always well above, the zero line in the bull market. And then we dip down below with the histogram, and, it could stay down there if we roll over. Obviously, we're due for a pullback. This market is overbought on 16 different ways from Sunday. So, if you're a bull, you don't have to buy today or next week. You can wait for another pullback. And bears are hoping they get a pullback here because it is bear hunting season right now. All right, so next we'll quick update on the earnings recession. I'm trying to make this video short, and so I'm going to show you the chart I've been showing you since January of what my targets are for a full valuation reset, and then we'll get an update on what the earnings recession looks like. So here we go. If the S&P is going to, let's look at the middle scenario. If the S&P is going to earn 115 bucks this year, and getting back to some kind of reasonable valuation of 15 times, the S&P would go to 1725. You look at today's price action, you don't even see it being possible. We'll see what develops. This is still, to me, a high probability scenario that we go down into the 1700s for a full valuation reset, given the earnings recession. So, update on the earnings recession with a caveat today, a big what if. And the what if is, what if investors have discounted the earnings recession enough so that they can see forward and see their way out of it. Okay, so here's where we are. This is data as of March 10th from Shiraz and his Excel tables, pulling all the earnings estimates. So earnings estimates for Q1 are looking at minus 9.5% growth, if you call that growth. Q2 slips to a new low of minus 4% growth. And Q3 is, is trying to stay positive, but it's still in jeopardy. Remember that song from the 80s, Greg Kinn, Our Love's in Jeopardy? I got to play that for you next time. See if we can hook that up. Great song. But the estimates are still in jeopardy, and that's why I've been a bear. That's why I'm looking for a bigger valuation reset. My caveat is if you look at this, have investors absorb this fully. Remember, when information is widely disseminated, when it's known and everybody's studied it and rehashed it 16 times, it becomes discounted into price. So back to this. Is this fully known and discounted? And, have we seen the worst in terms of the earnings recession and what's expected? If so, this market can find new legs here, and we may not make new lows. So that's, as long as the economy's strong, which it is, and as long as the Fed doesn't run away with hiking rates and invert the yield curve, which I bet they're not going to, then it's possible that investors have discounted the earnings recession and they see out past the worst. That means we don't have to make new lows. I'll revisit this topic next week or the following week after the Fed, and we'll see where we stand. All right, thanks for joining me in the kitchen. I'm Kevin Cook.